Hello, everybody. Luke Gromen, FFTT. Hope everybody is well. Had a great weekend and had a good start to the week this week. Just wanted to highlight a couple things here. I'm going to jump right in terms of some of the questions, try to maximize the time together. First question we had was from CC. Luke, what do you make of this a headline that just hit after the close today? Powell set to deliver profoundly consequential speech, quote unquote, changing how the Fed views inflation. This ties into a number of questions we had regarding Jackson Hole and what might be said. Clearly, he's going to deliver a consequential speech, or what the Fed sees as a profoundly consequential speech. What do I think this could mean? I would direct your attention back to a BlackRock white paper, BlackRock Investment Institute white paper, published the week before last year's Jackson Hole meeting. You can find it online. Google it. It was written by former Fed Vice Chair Stan Fischer, former Swiss National Bank head Philip Hildebrand, and former Bank of Canada Governor Jean Boivin. I would take the time to read this white paper right now if you haven't read it. It was something we saw last year. We highlighted it for our clients last August. We highlighted it a number of times since for our clients. It is a pivotal, profound white paper, probably 16, 20 pages long. It lays out the game plan. The paper was basically, in the next crisis, we are going to have to go direct. We are going to bypass the traditional interest rate channel. We are going to take the cap off of the inflation genie. We're not exactly sure how we are going to get it back in the bottle. Here's the game plan for the various regions. It is a step-by-step way that the central banks will implement MMT on their terms, working with the fiscal authorities. My suspicion is that Powell is basically following the game plan, that this is rolling that out. And for someone, importantly, for context, Stan Fischer, one of my best relationships on Wall Street, calls him the godfather of central bankers, was a mentor to both Bernanke and Draghi. Others that are very in touch have confirmed as much to me. So I wasn't sure what to think going into Jackson Hole. This headline, having seen it half an hour ago, I think we're going to see the Fed be more aggressive. So let's watch that. Second question from Daniel. I've heard your thesis many times, but how will the Fed prints it all scenario affect people in the euro area, and in particular Netherlands and Germany? My thesis is really around two things. Number one, oil and commodities are priced in the major currencies, dollar, euro, yuan, maybe sterling, but yen as well. But certainly euro, yuan, dollar. And then every central bank has to print their own deficits. And so under that scenario, Northern Europe ends up being able to buy oil and gas and other imports for their industrial machine in euros. That's a good thing. The trade-off is that their currency is likely to rise against the dollar because the Americans are going to print their deficits, and nobody can beat us with deficits. We've got the biggest ones. So, as Trump might say, they are huge. So, basically, what we're likely to see, what we are seeing a transition towards, and what we think will be the end game, is multiple currency pricing of energy and commodities, and every region responsible for financing its own deficits. And under that scenario, that would basically be a re-rating of currencies in the SDR basket, top to bottom, based on balance of payments. And so number one currency would be either Europe or China in terms of relative strength, the yen right there with them, and then the sterling weaker and the dollar much weaker. And then you basically compete on a more even playing field. Let's see, from RB, who is the biggest buyer of treasuries now? I understand the central bank stopped buying treasuries in third quarter of 14, and the global private sector stopped in 3Q, it says here 19, that's really more 3Q 18. Where do you see the real nominal yield on treasuries a year from now? So first off, it's interesting, you've seen FX hedged treasury yields, which went negative for the foreign private sector in 3Q 18, have turned positive since earlier this year. And so in theory, particularly for Japanese buyers, there is a yield pickup by buying U.S. Treasuries. So we'll see the Japanese private sector. I would not be surprised to see them participate more strongly than they have over the last 12 months in Treasury auctions. However, the biggest buyers, biggest marginal buyers have been the Fed, U.S. banks, commercial banks, and U.S. pensions and domestic mutual fund investors. And I suspect that those three, the Fed, domestic banks, and U.S. pensions and mutual fund investors, the U.S. private sector broadly, will continue to be the biggest buyers of U.S. Treasuries. Where do I see the real nominal yield on Treasuries a year from now? This is going to sound flip. It's not meant to be. I see nominal yields wherever the Fed wants them and wherever the Fed pins them, and wherever the Fed wants or pins them will be based on wherever is politically expedient for the U.S. government. Wherever is politically expedient for the U.S. government is probably around here. We've got a lot of debt. We have a lot of obligations. We have a highly financialized economy. We have a great power competition with China to finance. We have a lot of entitlements, and none of those things will be better with higher rates. They will all be better with lower rates, here or lower. So I suspect the U.S. would like to have a positively sloped yield curve with low absolute rates at the long end. And so I don't know that nominal rates will change a whole lot from where they are today. I think that's my final answer. And then Noah, what asset allocation would you recommend for a pension fund today? Today, I don't know where I'd be on equities, but the one thing I feel very, very strongly about is that I would be moving 2 to 5% of my bond allocation into gold and gold miners and or Bitcoin if I was a plain vanilla U.S. or global pension fund. Rates are near zero, and they can only go so negative, so there's only so much upside left for bonds. I don't think that there's a huge amount of nominal downside for bonds per my prior point. Sovereigns, I think, are likely to see rates capped at politically expedient levels. The bigger risk to me is the risk of inflation, and the bottom line is that gold has no upside on its price, no upside limit on its price. Bonds do, and so if we do get some sort of credit problem that really hurts the system, that increases the possibility. Gold ultimately, like the Dutch National Bank said last year, gold would be used to rebuild the system, and it would be used at a much higher price. And that's why central banks own gold. And so if that's why central banks own gold, it's unclear to me why pensions don't own a little bit of gold too, especially now that we're here. So that is it for today. I appreciate everybody joining me and for sending in the questions on Twitter. I also wanted to give a special thank you to everybody that bought my new book, the Mr. X Interviews Volume 2, released on Thursday morning. It was a new release in macroeconomics on Amazon, and spent some time as the #1 bestseller in macroeconomics on Saturday on Amazon, which was very exciting. So thank you to all of you for buying that. I appreciate it. If you haven't bought it, check it out on Amazon. Also, obviously, Volume 2 follows Volume 1, the Mr. X Interviews Volume 1. If you haven't gotten that yet, check it out. And as always, if you like these updates, check out FFTT Tree Rings. It's available at fft-llc.com. 10 most interesting things with some analysis and context. We've been getting a lot of great feedback from investors on that piece. It comes out every Friday. And with that, I will jump for tonight. Again, thanks everyone for joining me, and I look forward to catching up with you soon. Everybody have a great rest of your week. Take care.